Welcome into the Informed Investor Long-Term Thinking Weekly Insights. I'm Rob Black. Joining me today, Adam Phillips, Managing Director of Investments at EP Wealth. Always like starting these segments off, insights off, if you will, with a little year-to-date. Year-to-date, the Dow Jones Industrial Average is the winner, but it's down 2.5% out of the five major markets that I'm going to cover. The S&P 500 down 4.1%. Not so good. We're about halfway through March, so we're about one quarter through the year in that ballpark. The S&P Midcap 400 is down 6.2%. The NASDAQ down 8.1%. That is correction territory. And the Russell 2000 down 8.3%. Joining me now, Adam Phillips, to give us a little bit of color on this. Adam, are we in a correction? Are we heading towards a bear market? There's a lot of questions that people are throwing around. I'll just let you start with some perspectives on the year-to-date numbers and what you think we're seeing out there.
Sure. So look, right now, we do seem to be in a correction. We don't think this is going to turn into a bear market. Now, let me just put it out there that we're allowed to change our opinions if the data changes, right? But right now, we think that this really is just more of a sentiment-driven sell-off. Let's remember the fact that we came into this year, valuations were elevated, sentiment was stretched, and we were saying that, look, after 2 years where the S&P 500 returned more than 20%, closer to 25%, we were probably due. And so this is not too surprising. I think, if anything, if the market had continued to run here, given all the uncertainty that we're facing, I would have been a little concerned. I'm not too concerned about this, although it's never fun to deal with this type of downside volatility. So we are in a correction right now. The S&P 500 sold off. The drawdown hit 10% last Thursday, I believe. That was actually a very fast drawdown and correction. It took, I believe, 16 trading days to go from an all-time high to a 10% drawdown.
Wow.
That happened very, very quickly. I believe 2018 happened in just 9 days. But it was driven by the same thing, really. Concerns about a trade war, an economic growth scare. So it's kind of funny how we're seeing the situation just kind of replay itself right now. But ultimately, I think the market is responding to the fact that we're in this limbo period, and it's very hard to know where things are going to shake out. But for now, we are focused on the fact that it was overdue. We expect that to be in this choppy environment for some time until we get some clarity. But do we think that this is going to turn into a bear market, meaning a 20% drawdown? We don't currently think that's the case. I will just provide some historical context here, Rob. So since 1974, so call it 50 years or so,
Okay.
we've seen 27 corrections, meaning 10% drawdowns from an all-time high. That includes this most recent one. So this happens every, let's call it 2 years or so. 6 of those have turned into a bear market. So just over 20% of the time, we've seen these turn into a 20% sell-off or a bear market. So I think the odds are in our favor right now. We're going to, like I said, we expect this volatility to remain with us, but we're going to be focused on the data here. And so far, the data is telling us this is more about a sentiment driven sell-off, more about a near-term growth scare than anything more sinister. But we'll continue to watch as things play out here.
So I'm not 100% sure that I have this quote accurate, but Will Rogers, famous American, once said, "I would like to meet a one-handed economist," so that you don't say on the other hand. Are you being pessimistic or are you being optimistic with what you're seeing in the markets right now? And again, pretend you only have one hand and give me a straight answer if you can. I like pullbacks. I like corrections personally. To me, it gives me a chance to average in or get in or feel better about buying at a lower price than a higher price. Because like you said, we're 16 days or so from an all-time high. That's not bad. But anyway, one-handed recession. Adam, go.
I'm being realistic. How about that? Look,
Okay.
I mean, we came into this, as I said, with high valuations, elevated sentiment. What that means is that additional upside is hard. It's hard to find that catalyst to drive the market higher, and it also means that the market is vulnerable to disappointment. And that's really what we've seen here with all this trade talk and policy uncertainty, and that disappointment has led to this sell-off. Now, do I think this is going to turn into a recession? No, I don't. I think that we're seeing a softening rather than more of a crisis playing out here. So I think that we need to, as long-term investors, you can view this opportunistically as long as you're mindful that you may not catch the bottom. We may have a little bit further to go here, but as a long-term investor, we know that the market moves higher over time. And this could be an attractive entry point. Look, I'll just note that the S&P 500 is down. As I said last Thursday, it closed at 10% below its all-time high. It's since recovered a little bit. But if you look at the sector level, a lot of this is really driven by weakness at the top. Those companies that have been leadership for the last couple of years are the ones that are really faring the worst in this market. The Magnificent Seven, we've talked about those companies so many times over the last couple of years. They are down 20% from their all-time high. If you look at the 11 sectors of the S&P 500 on a year-to-date basis, 9 of those 11 are actually outperforming the index. That means that just a couple of those big sectors, of those big names, are dragging everything down. And so I think that tells you that it's not weakness across the board. Yeah, I mean, there's a lot of red on the screen, but the weakness, the pain is really being felt in some of those more high-flying names. It's technology, it's consumer discretionary, i.e. Tesla, really driving things lower here. And so I think this is more about a rotation at this point, where you're seeing people just kind of gravitate from those names that were leadership for so long into other areas that might provide a little bit more safety in this environment.
So let's talk a little Trump tariffs because my children ask me and I struggle to explain things. So I need your insights. Are tariffs taxes? What are we looking at as far as the uncertainty and the volatility that it's creating on Wall Street? Um, because the messaging seems to be evolving, is I think a friendly way of saying that. Um, are you thoughts on tariffs?
I don't like them.
Okay.
Uh, so we've been dealing with this for several weeks now, and it's I don't this is I'm kind of exaggerating here, but it would almost be better just to say, yeah, these are the tariffs, we're doing it.
Yeah.
This isn't a negotiating tactic, just so that we would remove this layer of uncertainty right now that has everyone on edge. It's like, let's just get it over with, right? Rip that Band-Aid off, and then businesses can start planning, households can start adjusting. It's really this limbo period, I think, that hurts the most. But to answer your question directly, yes, we generally believe that tariffs are taxes. They're taxes on corporations, and to the extent those corporations pass them through, they're taxes on individuals as well. And so, generally speaking, you do see a bump, a move higher in inflation. Whether that would be the case this time or not, I think remains to be seen, and that's up for debate. We can talk about that, but I think that what you're seeing in the data, Rob, is that this limbo, this period of uncertainty, it's really wreaking havoc on the minds of businesses and management of these companies as well as households. You look at the survey data, and you're seeing that plans for major investment are moving dramatically lower because companies don't know if they want to go and expand in this environment. They don't know if they want to hire in this environment. On the individual side, you're seeing the same. Well, last week you saw Delta, you saw American Airlines. They slashed their guidance and they said people don't really want to travel in this environment. They're scaling back on purchases. They're not really sure what the job market will look like in the next few years, or excuse me, next few months. And so all of this, I think, tells you that we often say inflation can be self-fulfilling. Look, recessions can be self-fulfilling too. And so I think the longer this drags on, the more it wears on the psyche of households and businesses, and the harm to the economy, will start to be felt. But if we can get to some sort of resolution relatively quickly, I think we can kind of get back on track here. But I think the longer we're kind of in this limbo period, the more pain we'll see.
Yeah, let's see if I can't add a little color on that. Whether you're a restaurant owner in the United States who sells avocado toast, or whether you sell shoes that are manufactured in China, There needs to be a little more certainty for businesses. Or am I paying 20% more or 20% less, or am I paying what I used to pay? So there seems to be a freezing mentality of let's do nothing until we know. Is that kind of what you mean with like soft data and hard data? Like, where does the frozen business or the frozen individual come from?
Yeah, exactly. So when I say soft data, that really just refers to surveys,
Service. Okay.
confidence measures, or surveys that are done with businesses. They go and ask more things like, how are you feeling? What does the current environment mean for your plans going forward? What are you seeing? Same thing with individuals. What do you think about what do you think the job market's going to look like over the next several months? What do you think your personal finances are going to look like over the next several months? Think they're going to be better or worse, right? Questions about inflation expectations. It's these that are really showing the warning signs and can sometimes be leading indicators. Meanwhile, the hard data, what is the actual data telling us, right? Consumers might feel bad, but their actions often speak louder than their words. And so far, we're seeing that you're looking at spending measures of personal spending, consumer spending. They're holding up. They're softening a little bit, but they're holding up. The jobs market is still holding up. So it's this hard data that still tells us that we have some time to figure this out. If we can get some clarity on things like tariffs, then that might say produce some sort of a bump in the survey data, in that soft data, and then we won't see that a hit to the hard data, right? And the economy can kind of get back on track. That's how I'm really looking at the world right now. But as I said, the longer that we're in this period of uncertainty, the more risk that you run of doing some major harm to the economy.
Okay. Okay. So I'm getting it. I'm digesting it. Whenever I travel with my kids when they were very, very young, I taught them that turbulence was okay. Like I say, have fun. This is fun. Like I did the opposite. I don't get nervous in front of my kids. Um, Same idea kind of going on with Wall Street right now, where I'm like, there's volatility. I'm like, I'm not saying have fun with it, but there's some real concerns for retirees, and there's some real concerns about the next couple of months. How do you look at volatility? Positive, negative? Is it action, pin action, like in bowling that you like to see? What are your thoughts on volatility? Because it certainly feels more volatile right now based on headline news.
It absolutely is. And I don't enjoy volatility, but I think that in certain environments you need to look at it as very, very healthy. And this is one of those. I said in the beginning that coming off of two really strong years when we didn't see any volatility, that led to valuations being somewhat elevated coming into this year. And given everything that we're facing right now, all of the uncertainty out there in the world, if we saw the market continue to move higher and really turn a blind eye to all this uncertainty, that would have me really nervous. And so I'm actually viewing, I welcome this volatility because it shows that investors are paying attention. They are not becoming complacent. And I think that's a very, very good thing. As I said, you see these corrections once every couple of years. And so this is normal, right? And it will pass. These things generally pass. And, I guess the range for a 10% drawdown to recover is called anywhere between 3 and 8 months, right? Past performance is no guarantee, but I think that helps to at least provide some context about what the future might look like. Forward returns over the 1 year horizon after you hit a 10% drawdown, they're generally positive. The average return over the next 12 months is about 15%. So I think that investors should really think about that. You view it through a long-term lens, and I think it helps you get through. What we are doing within the portfolios is we're watching. If we have some cash that we are working portfolios in, then we would view this opportunistically and put some of that money to work. Again, not necessarily expecting that we're going to call the bottom to the day, but we feel good as long-term investors. Let's buy on some of that weakness. And within the portfolio is we don't want to make abrupt changes in an allocation until we really know what things are going to look like once the dust settles. And right now, it's very, very hard to have much clarity. And so, but we're watching. We're watching to see how things play out, and we're going to make adjustments across all of our strategies as needed. And so, a short answer to your question, Rob, is I welcome it, and I think it is very healthy.
super softball because I'm out of questions. Any last thoughts? Anything that you want to contribute that I've missed today? I know we've passed, we can go into Fed, we can go into, the
Yeah.
next election cycle. There's so much to go on. So this is a freebie for you. Where do you want to go?
Well, look, I'll take it easy on everyone and not go into the Fed talk. I think we can cover that next week. We do
Okay.
have the Fed meeting this coming. They start tomorrow. They're coming out of it on Wednesday. And we'll touch on that next week. But I just parting thought, Rob. You mentioned the retirees, and I think that's very real, right? I say that volatility is normal, and I welcome it. Doesn't mean that everyone does, and I certainly don't want to suggest that I enjoy this. So for those, if you're a retiree or you're entering retirement or you're just nervous, this is a great opportunity to talk to your financial advisor. Revisit that financial plan because that is the best way to really provide that overall context and really restore your confidence that you can weather this storm. And that's what the financial plan is there for, is really just to stress test and make sure that you can make sure that you can stay disciplined and remain on that long-term trajectory, stay disciplined and focus on that long-term investment strategy.
Sounds good. That's how you do it. Ladies and gentlemen, Adam just explained it all. Rewatch it if you need to one more time. The Informed Investor Insight. I'm Rob Black. He is Adam Phillips, Managing Director of Investments at EP Wealth. Don't be shy about reaching out to your financial professionals. It's always good to have more communication, especially if volatility, roller coasters, airplanes make you nervous. Stock markets do too. I get it. Thank you so much and have a good day. Talk to you soon.